Okay, hello and welcome to another tutorial. As you can see, we're going to go through the income statement here and cover some of the key points and what you need to know about it for interviews. So this is a bit of a follow-up because we did get a lot of questions and requests based on the previous video on the balance sheet to cover the other financial statements, the income statement and cash flow statement. So we are going to do that. The cash flow statement will be next, and I might even do the statement of shareholders' equity after that. If you want this tutorial in writing, along with the screenshots, the PDFs, and some of the sample Excel files here, you can go to this URL. Just go to our knowledge base, the accounting section, and then income statement. I will also pin this URL below the video as usual. So let's go through the short answer first, and then if you want to keep watching and you want more detail, we'll go into some of the more advanced points. The income statement in accounting shows a company's revenue, expenses, and taxes over a period of time, such as 1 year, 1 quarter, or 1 month. Now, to appear on the income statement, the item must correspond to either delivery or allocation in the period, and it needs to affect the business income that is available to the common shareholders, in other words, the owners of the business. Some of the main line items or sections on the income statement include revenue, which is almost always the top line item and represents net sales across all segments. It's based on delivery rather than cash received, at least for large companies and public companies and things like that. So I'm going to pull up a very simple example of an income statement here. For a business that sells online courses and coaching, you can see here revenue, we record a dollar amount for the online courses and then another dollar amount for resume editing and coaching, and we add those up to get to the total revenue. Now, the next item that you usually see is something like COGS, cost of goods sold or cost of sales. This represents the per unit selling and delivery costs, which means that they're 100% variable. So in this example, you can see how we have a cost of goods sold for online courses, which, as you'd expect, is very low relative to sales, and then another cost of goods sold for the coaching and resume editing, which is much higher. We're getting about a 50% margin on this because, of course, we need to pay people to deliver it and to actually do the coaching. If we were dealing with a company that sells physical products, the cost of goods sold might include things like the raw materials and the manufacturing costs and the delivery costs of those products. Once you go below cost of goods sold, you get to operating expenses, which represent the cost of anything that cannot be linked directly to individual units sold. So if you look at our categories here, this could include employee salaries, it could include rent or accounting and audit fees, IT, insurance, marketing and advertising. But for most companies, usually the biggest component here is employee salaries for workers that are in different functions at the company. Then you have other income and expenses. So if this business also does something small and miscellaneous, like operating a small retail store, you would see the revenue and expenses for that somewhere down here in other income and expenses. You would also see financing line items here, such as the interest income and the interest expense if the company has debt or if it has cash and investments that it is earning interest income on. Then you have taxes, which represent what the company owes to the government based on its revenue minus expenses in the period. Now, these are the main sections, but in addition to this, there are also some useful summary line items that we'll go over now. First off, there's operating income, which represents the core business earnings before taxes, side activities, and financing costs. And in our very simple example here, you can see it equals the gross profit minus the total operating expenses, or you could say that it's equal to revenue minus cost of goods sold minus operating expenses. That's another perfectly valid way to calculate it. Then there's net income, which is the bottom line, or the profits generated after the expenses and taxes in the period. You can see it down here in our model. We're paying about a 25% tax rate on pre-tax income of 200, which gives us profit after taxes of 150. And this is pretty much always the bottom line on the income statement, although there are some variations of net income that we'll discuss in a little bit. In real life, when we're working with actual companies and going through their filings, we often modify their income statements. Sometimes we show more detail and sometimes we show less detail. So if we look at this example from Monster Beverage right here, we haven't modified their income statement by a huge amount, but if you look at how ours compares, there are a few clear differences. One difference is that we're showing revenue in more detail because we find it useful to separate it into segments. Other than that, though, we have most of their line items: cost of sales, operating expenses, interest income, other income and expense, taxes. We also have some more summary line items here for gross profit, operating income, and so on and so forth. Another change is that we tend to change the signs so that the expenses and taxes are always negative. If you look at something like the company provided statement here, It takes a little bit of effort to set this up because you have to remember that even though cost of sales is positive, you subtract it from net sales to get to gross profit. We think it is better and less error prone to set it up like this, where the cost of sales is already negative, gross profit is positive, operating expenses are negative, and if you set it up like that, it tends to be less error prone. You don't need to think as much about what you're doing with each line item. So those are a few examples of changes that we often make to the income statement in real life. Let's now go through some more detailed topics. And I'll start with some more advanced line items. Then we'll go into why certain items appear or do not appear on the income statement. Then we'll look at how you forecast the income statement and some different options for revenue and expenses. And then we'll look at the income statement in interviews and what you need to know when you get accounting interview questions. So in addition to some of the items I just showed you, there are more advanced ones as well. There are gains and losses, there's depreciation and amortization, impairments and write-downs, preferred dividends, net income from equity investments, or net income attributable to non-controlling interests. And we actually have videos on some of these, so I will link to the tutorials on equity investments and non-controlling interests. We also have one on gains and losses. So these take a bit more work to explain, and so I'll refer you to some of that other coverage. Of this list, I would say that depreciation and amortization is by far the most important one to understand and know about. This represents the allocation of previous capital spending over many years. So if a company buys a factory, it cannot just list that as an expense on its income statement because it's not going to be good for just 1 year. It's going to be good for 10 years or 15 years or 20 or even 30 years. And so they need to allocate that spending over time, which is what depreciation represents. It's useful for many years, so they can't just list the whole thing up front. They have to spread it out over time. The tricky thing is that the depreciation could appear in different ways on the income statement. It could be a separate line item, or it could be embedded within other line items. If we go back to the Monster example here, they don't list depreciation anywhere on their income statement, but if you scroll down and look at the other statements, go to the cash flow statement, for example, it is listed here as a non-cash adjustment. So it must be somewhere on the income statement. It's just that what they're doing is putting some of it within cost of sales or operating expenses or both, and so they're not showing it as a separate line. So that is something to be aware of. You will encounter many variations of that when you're working with companies in real life. One question we get a lot is why certain items appear on the income statement and why other items do not. For example, in more advanced models, you will see preferred dividends as a deduction on the income statement, but not common dividends. Let's go to an example right now. So I'm pulling up here one model that we have to help with accounting questions. And when you look at net income, preferred dividends is a common deduction to get to net income to common, but common dividends themselves are normally on the cash flow statement in cash flow from financing. So we get questions about why that is. We also get questions about why interest expense appears on the income statement, but then debt repayments and debt issuances appear on the cash flow statement. So why is this? What is the logic for these items? The short answer is that you want to think about the basic requirements here, the delivery or allocation in the current period, and then whether the items affect the income available to the owners of the company. So preferred dividends satisfy both conditions here because clearly they correspond to something that happens in the current period because the preferred stockholders get paid in this period. And then also it directly affects the income that's available to the common shareholders because the preferred stockholders are senior to them. They have payment priority, and so they get paid before the common shareholders can get anything. And that's why preferred dividends tend to show up on the income statement. With this question about why common dividends do not show up, the short answer is that although they do correspond to something in this specific period, they don't affect the income that can potentially go to the common shareholders. They are the income that goes to the common shareholders. So they're quite different from something like the corporate taxes or the operating expenses or things like that that actually reduce how much can potentially be distributed because they represent the actual distribution. With debt issuances and repayments, the logic here is that these correspond to longer term items because debt typically stays outstanding for many years, and issuing debt and repaying debt doesn't just affect what happens in this period, it actually affects everything beyond that up until the debt is completely repaid. Interest expense, by contrast, is just the expense that the company is paying on the debt in this current period, but what they pay in interest in this period doesn't directly affect what they're going to pay in future periods for the most part. There are some exceptions like paid in kind interest, but if we're talking about simple cash interest, it doesn't really make an impact. Let's now go into income statement forecasting. So you might look at an income statement such as the Monster beverage model that I brought up before and ask, how should we project these items? What should we do for revenue? What about cost of sales? What about operating expenses? The first approach is that you could just use simple percentage growth rates and margins for revenue, COGS, operating expenses, and so on. The second approach is that you could try to use some type of unit economics for each one. So maybe the company sells 100,000 widgets per year at $10 each, and then maybe it costs them $3 per widget to manufacture, deliver, and sell them to customers. If you have something like a 30 to 60 minute case study or 30 to 60 minutes of time, you probably want to stick to relatively simple percentages. And then if you can, use unit economics for revenue, but it's not absolutely required. In this Monster example, you can see what we've done up here, where we do have a bit of that happening because we do assume an average net sales per case. We assume a total number of case sales. We have something about the market share and the overall energy drink market. But then for some of these others, we just assume simple margins for the gross margin, the operating expenses, even something like the interest income and interest expense are also effectively simple percentages of cash and debt, for example. This is a 30-minute model, and that's why we take a simpler approach. Now, if you have more like 2 or 3 hours, you probably want to go a little bit more in depth and use unit economics for more line items. So I'm going to pull up here a 3-hour LBO model. And in this one, for this casino company, we project the total gaming square feet, the usage rate, we project the gaming revenue per used square foot. So we go into it in a fair amount of detail. And then when we get down to some of the expenses, we look at things like the total amount of employee salaries and the total employee count based on the square feet the company is actually operating. So it really depends on the context and the resources at your disposal, but these are some general guidelines. In terms of the income statement in interviews, the most important thing here is that you always want to start with the income statement and then move to the others, because before you answer anything, you need to know how net income changes or if it does not actually change. Don't say anything about whether gross profit or operating income or other line items in between change. What you really want to focus on are how pre-tax income and net income change. So for example, if they say, what happens when accounts receivable goes up by 100? Assume no corresponding expenses for simplicity. So we're just dealing with a change in accounts receivable here. What does this actually mean? Accounts receivable is on the balance sheet, and so you might look at this and say, okay, let me start with the balance sheet, but that would be wrong. You still want to start with the income statement because you have to think about what this scenario means in real life. So what this really means is that the company has delivered a product for $100, but it has not yet collected the cash for that product from the customer. So on the income statement, revenue goes up by 100, pre-tax income goes up by 100 because there are no corresponding expenses here for simplicity, and net income goes up by 75 at a 25% tax rate. Let's actually pull up a simple model here to show you what happens. So if I say that accounts receivable goes up by 100, revenue is up by 100, and then pre-tax income is up by 100, our net income is up by 75. Now, on the other statements, if we go over to the cash flow statement, net income is up by 75. We record a negative for the change in accounts receivable. So this is negative 100 because they haven't collected this 100 in cash yet. Therefore, cash is down by 25. And then on the balance sheet, the cash is down by 25, AR is up by 100, and so our total assets here are up by 75. On the other side, equity is up by 75 because of the fact that net income was up by 75, so both sides are up by 75 and balance. So we always go in that order, starting with the income statement, moving to the cash flow statement, and finishing with the balance sheet. And I just have the rest of the steps laid out down here. Again, the most important thing here is that you really need to start with the income statement, even if something doesn't appear to be related to it, or it's a line item on another statement first, because there are often effects on the income statement depending on what this line item actually means. That's about it. So let's do a quick recap and summary. We started out with a very short and simple introduction to the income statement. In short, to appear in the income statement, it has to represent delivery or allocation in this period, and it has to affect the income that is available to the common shareholders, the owners of the business. The main sections are revenue, cost of goods sold, operating expenses, taxes, other income and expense, interest income and expense, taxes, and then we have some summary line items like operating income, pre-tax income, and net income or profit after taxes. We went through some more advanced line items. With depreciation and amortization, you have to be careful with how companies record it. It represents the allocation of CapEx over many years. that can appear in different places and be presented in different ways on the income statement. In terms of whether an item appears or does not appear in the income statement, just think about the delivery or allocation in the period and then whether it affects the common shareholders. So if it's some type of payment to other investors in the period and it's going to reduce how much goes to the common shareholders or how much can potentially go to them, it's going to appear on the income statement. If it's more of a longer term item that maybe doesn't make a direct impact in this period but will affect future periods, that's probably not going to be on the income statement. It's probably going to be more of a cash flow line item. Income statement forecasting, you can use either simple percentages or unit economics. We prefer simple percentages in very time-pressured case studies, but if you have more time, such as a few hours, it's usually better to look at individual units sold or square feet or sales per square feet or things like that. And then the income statement in interviews, the most important thing is you always want to start with the income statement, explain how the change affects pre-tax income and net income at least, and then move to the cash flow statement, finish with the balance sheet to check your work and make sure the balance sheet balances. That's about it for the income statement. Hopefully now you have a better idea of what goes on it, how different line items appear, what they mean, and what you should know about it for interviews.